It's all about debt. It's about this debt bubble bursting. Everything is pointing to a slowing economy, going into recession. They're absolutely trapped. There's no way out of this. The debt bubble has reached a point where there's no way out. I just want to accumulate as many shares as I can get my hands on before they get pricey. And they're cheap right now. As far as I'm concerned, 2026 is noise. That's all it is. It's a period where we can accumulate. For me, the top of the mountain is $7,000 gold. I think silver will be somewhere 175, 180, somewhere in there. Now, we probably will rip to 250, 280 at a certain point, but it'll come back down. This is the end of the American empire. I firmly believe that we're going to see revolutionary change. We're going to see banks close in large numbers. We're going to see colleges close in large numbers. We're going to see businesses close in large numbers. When the reset comes, the dollar is going to be devalued anywhere from 30 to 40%. So you're going to wake up one morning and your bank account's going to be worth 30 and 40% less, and your stocks and bonds are going to be worth 30 and 40% less. But guess what? Your gold isn't. That's the reason why you stack gold and silver, for the reset.
This is Little by Little with Andy Schectman.
Welcome back, everybody, to another episode of Little by Little. I'm excited to bring my good buddy, Don Durrett, into the studio today. Don will be one of the first repeat interviews that I have done in about a year of doing interviews, and I'm starting to loop back around and bring some of the previous guests back in, and I couldn't think of a better time to bring someone in like Don. His expertise in mining shares and just in precious metals itself. Don is the founder of the Gold Stock Data website and author of How to Invest in Gold and Silver, a book that specializes or deals with not just investing in gold and silver, but also how to deal in gold and invest in gold and silver mining shares. Don, welcome in, buddy. Good to see you again, and thanks for joining.
Yeah, Andy, this is a really good time to do this interview. Your gold's had a significant correction over the last 2 days. Gold's down $150 yesterday, down another, I'm not sure, but we trended all the way down to 4,600, 4,605. It bounced a little bit, 4,635. I think we started the week at 5,000. So yeah, big correction. And I really am, the timing's beautiful for this because both me and you, we're educators more than anything else. I mean, I'm an investor. I basically invest in gold and silver mining stocks, but I'm also a teacher. I've written a book on how to analyze these things. I'm on Twitter. I'm always trying to educate people. For me, it's all about education. So today's a really good opportunity for us to let people know why silver's going high, why gold's going higher. Silver's just a ride. I want everybody to, that's one thing I always say. This is a story about gold. So we're really talking about gold. Gold trends higher, silver's coming along for the ride. It's pretty much that simple for silver. I've always said that. People, the GSR went to 120. Everybody said this is, it's going to stay there. I'm going, no way in hell. Gold goes higher, the GSR is going to squeeze. It's very simple. The odds of that happening are very, very high. I have the microphone. I'm going to keep talking. So I want to start talking a little bit about why gold's going higher here. I want to start all the way back to 1945. I'll do this fairly quickly. But from 1945 to 1971, the U.S. had a mercantilistic economy. 1971, August of 71, Nixon took us off the gold standard. From that point forward, everything started to break in America. That's the reason why gold's going higher. But we have to look from 1971 to today to really understand why gold's going higher. So the 1970s, we had the inflation, we had the two energy crisis, we had the stagflation, we had the malaise of the Carter years. And then 1980, Reagan comes in. And Reagan makes two fatal mistakes for the future of America. The first fatal mistake he did was globalism, which we're all realizing just basically destroyed the American economy. I mean, we're not going to recover from this. Globalism destroyed us. We're seeing it with the cost of living, and the middle class is basically getting hollowed out. You can't afford a house anymore if you unless you have your parents are helping you out. So globalism was a terrible mistake. We thought we're going to have a services economy. Didn't work, right? The second thing that Nixon did was he created voodoo economics, which George Bush eloquently and masterly defined, which was spot on, but everybody ignored him. And what's voodoo economics? Voodoo economics is this idea that you can print money, but printing money is actually theft. You're just stealing from consumers, stealing from, hard workers. Money is supposed to be created through wealth creation, which is what mercantilism did. That's wealth creation. We didn't have to print money. You could, but the whole banking system is flawed, and that kind of builds into it. Basically, it amplifies money printing. For instance, here's a good example. So I go and deposit $10,000 into a bank. A bank can take that $10,000 and basically multiply it by 5, 6, 7, 8. I'm not sure what the number is, and then make a loan. Let's say you have a home equity loan. The home equity loan is collateralized against a lien against your house, and then they get 14% interest. So they make a loan out of thin air, and then they get paid back 14%, which is double the loan. So you get a loan at $25,000, you pay back 20 years, 14%, you pay back 50,000. They get a 50,000 in free money, and that's how our banking system works, which is, it's basically ludicrous, I think. So that's breaking the system on top of it. And then now let's go a little forward. Okay, so Reagan started doing deficit spending, which is during a period of growth, which is exactly the same thing we did from 2010 till now. We had growth. We haven't really had a recession since 2009, and yet we've had the deficit's grown from about 5 trillion in 2000 to about 39 trillion today. So we have $2 trillion deficit, and we're borrowing about $1 trillion every 6 months. Our deficit is increasing. So we're reliant on debt. And where things really broke, this was all building, printing money, living off of debt, when, we basically weren't living off wealth generation. We're living literally off of printing money. And this was a doom loop. This is the reason why I got into gold, because eventually it pops. Von Mises said it so well. He said there's only 2 ways to get out from under a debt bubble. You either pay it back, which we can't do, or it bursts. And so what's happening, and we knew it was an inevitability, and now everybody starts to realize it. So what happened was February of 22, the Ukraine war started. And from 22 to 24, everybody kind of ignored what was going on globally, where you had Russia and you had India and you had China basically all becoming buddy-buddy. These are natural enemies, and they're becoming buddy-buddy economically, creating basically the global south, which Andy talks about all the time with the BRICS plus, with using gold as a final settlement. This isn't going away. This is actually expanding. So 2 years, from 22 to 24, everything was kind of fine with gold. In February of 24, gold was $2,050. Then in February of 26, 2 years later, it was $5,600. Well, January 29th, and then it went down a little bit after that. January 29th. Let's call it 2 years. It went up $3,600, $1,800 a year. Why? It didn't go up $1,800 a year because we had inflation. Inflation was going down. It had nothing to do with inflation. It had to do with everything I've been explaining to you. It's all about debt. It's about this debt bubble bursting. And the key here is once the U.S.'s debt level got too high, which is what it did, at that point, you get into a doom loop where it's impossible to get under control. When it's impossible to get under control, what you end up doing is exporting inflation. Because when you're printing all that money, the more you print, the lower value the currency becomes. And printing money is basically a monetary phenomenon. So when you print money, you create inflation. And we're printing money, like banshees. And so China figured this out in 2013. In 2013, China held 1.5 trillion of our bonds. Since then, they've had a net, basically they bought a little bit, they sold more than they bought since 2013. Now they're down to about 650 billion. They figured it out a long time ago. They can see where it's going. Now everybody else has figured it out. And that war in 22 figured it out. So gold is going higher, but I'm only giving you a little bit of an overview of why things are breaking. The bad news is that where we're going forward, we're going point forward, but there's no path forward here where silver dies here at 4,600 and just doesn't go back up. The reason why we're at 4,600 is because the war, plain and simple. The war basically was a trigger for gold and silver to take off. Very common. You get a crisis, gold goes down. We've watched it over and over again. So we're in a crisis, gold's going down. Now, I said that we were going to see probably $4,500 gold, 4,800, somewhere in there before the end of June, and we would see around 72 silver before the end of June. We're already there. So now we're going to go a little lower. I bought gold and silver mining stocks today. I bought the dip. So we're going lower. You know, you never buy the bottom, right? So we're going to go lower. The question is how much. But we're in a situation now where we can buy to the bottom. We can look for stocks on sale, and we can, you know, buy them now and just keep buying them, because we're going to hit a bottom here. We're going to bounce. I firmly believe gold and silver will have an all-time high by the end of June. The reason why Jordan Byrne did a look back on gold and silver, and he basically, especially gold, he found that in a gold bull market, the longest correction was 5 months. And 5 months would be, it started, you know, basically February 1st to July 1st would be 5 months. I think that's probably history's gonna rhyme there. I'm not worried at all here about gold dying, silver dying. Yeah, silver could go back to $50. It's possible. You know, we're at $70 today, 72. It's possible because the S&P 500 is just starting to roll over. One last thing, Andy, I want to talk a little bit about how we got to where we're at. So I called it 4 battles to win the war. The first battle was gold breaking out, which was February in 24. Gold won the battle. February, March of 24, gold was off to the races. It was very clear, I thought. First week of April, I went bullish gold. The second battle, it took another almost 18 months. It wasn't until August of last year. That's when silver broke out from $35 and ripped and just took off from 35 to 70 by the end of the year. The third battle was the mining, was the HUI, which broke out with silver. The fourth battle is the battle we're fighting right now. And that battle is the S&P 500. And I always said that the last battle is going to be the ugliest, and it sure is. This is the final battle. So this is when gold and silver decouple. This is equivalent to 2002, that period, 2002-3, when gold and silver started outperforming the stock market. That's what we're waiting for, that same thing. All right, Andy, I'll let you ask me a question.
Well, you kind of stole a little of my thunder. I got to admit, Don, I had a bunch of questions to ask you surrounding what you talked about, so I'll have to kind of shoot from the hip on this one. But you know, let's make it easy at first. You alluded to it. You know, the fact that we've seen war in Iran and oil above $100 and a stronger dollar. Yet gold and silver, after this initial fear bid, have turned weak and choppy, and that confuses a lot of people. So you kind of touched on it, but let's start here. Is this just noise and start inside of I guess call it a much bigger bull market? Or is this something much more important happening underneath the surface? I think people would like to hear your answer on that.
Yeah, that was the reason why I entered my overall explanation. I think I kind of answered that through that. But one thing I want to point out here is that the final battle, I believe, has been building for years, really. I mean, if COVID, we spent $4 trillion and injected $4 trillion in 2021, 2020 from COVID. And all that money injection just kind of kept everything afloat, if you will. I think we probably would have went into recession without that. But now, I mean, if we look, this final battle is all about basically going into a recession. And that's where gold is going to shine. That's when gold's going to win. I mean, all I have to do is look from 2000 to January of 2000, the dot-com bubble burst. And then September of 2001, we had 9/11. And you had a recession out of that. From 2001 till, you know, the entire decade, stocks pretty much sucked. They really did. They did. If you were fully invested in the stock market in December of 2000, you didn't make any money for the whole decade. And so gold and silver do well. So we're waiting for that. So if we look at the factors right now, the factors that we haven't gotten into a recession yet and how close we are. Okay, if you look at consumer confidence, Michigan number, it's at 55. The all-time low is 54. As far as the consumer is concerned, the economy sucks. If you look at the cost of living, I would say 50% of families can't pay their budget. They're cutting something out. That's my point. You look at the Buffett indicator, that's been screaming for a long time, right? That's basically the valuation of the stock market versus GDP. If you look at unemployment, the unemployment rate, went from 2% all the way to 4%. That's usually screaming at recession. The inverted yield curve, 10-2, that normally points to a recession. This recent oil surge, anytime you have an oil surge, historically, you get a recession. The Somme rule. The Somme rule was kicked in. That normally says you're going to have a recession. The LEIs, those have been, telling us recession, recession. The ISM numbers, 38 out of 48 months, sub 50. And then the housing problem today, right? Housing is a total mess. The inventory's going up. Nobody can sell their house. So everything is pointing to a slowing economy, going into recession, which is more fundamental strength for gold, because you had about $70 trillion in the stock market, the total stock market in the United States, about 70 trillion, maybe a little lower than that. Now we've had a 5% correction back down to 65 trillion. Well, guess what? About 20% of that is foreign money. And that foreign money, right now, I've said, going into this year, I said, what's going to happen with the stock market is you're going to get stuck in a trading range. We're not, because there's nothing to really drive it higher. Coming into this year, AI basically was down, and AI has been down, right? We had this rotation. So if you don't have the AI, generator, what's going to push this thing higher? So I thought, you're going to get into a trading range. And you get into a trading range, eventually you're going to get a correction, which we have today, down 5%. And then that foreign money, that $20 trillion starts leaving. And then the retail's is hot money as well. They'll leave too. And then basically it's just kind of, you get into then kind of self-fulfilling prophecy, which I think is inevitable. I said it was going to happen the second half of the year, but it looks like it's going to happen the first half. We'll see what happens.
I guess tied to what you're saying, much of which I agree with, it seems to me that the central banks, the U.S. central bank, Federal Reserve, more than any, but all of them for that part, for the most part, seem trapped. They want to ease, they want to support growth, but as you alluded to, inflation and energy keep taking that flexibility away. It's very obvious. I assume you feel that the central banks are trapped here, that they can't raise because they'll break the system, and if they don't, then inflation perhaps runs away. Are they just out of room at this point?
You're being very kind to the economy, very kind. You're actually giving them a chance. No, they're absolutely trapped. And there's no way out of this. The debt bubble has reached a point where there's no way out. And now we've used this term "kick the can," right? And kicking the can was always injecting money, injecting liquidity, bailing companies out, expand the debt. When Greenspan was in office, Greenspan didn't leave until 2005, and Greenspan was kind of old school. When Greenspan left, the Fed's balance sheet was $800 billion, which is low, right? $800 billion, it was like peanuts. It was kind of the equivalent of Reagan. When Reagan came in, it was under $1 trillion. The Fed basically was under Bernanke, kind of old school guy. He was like, okay, we're going to keep kind of doing the same thing. Bernanke came in 2006 and flipped the whole thing. He basically was pulled a Reagan, and he started printing money. He introduced MMT. And so he's the guy that basically rug pulled the Fed. So now the Fed has, $7 trillion balance sheet. So he's basically 7x Bernanke, Greenspan. And now he's put that in motion. And so now the Fed is like, oh, we can just do what Reagan did. We can just expand our balance sheet. We can just print. We can, and people have talked about the Fed expanding their balance sheet to, 12, 16, 20 trillion and kicking the can and everything's going to be fine. The problem is inflation. They can't do that. They can't inflate their way out. And so what's going to happen they're absolutely trapped because they can't print like, as much as they want to. It's very similar to what happened to Japan in 1989 when they basically had their bubble burst and all that foreign money left. The Japan stock market in 1989 was 50% of the global stock market. It's 50. We're about 60 today. And it collapsed down today. It's 5 today, 5. So that's going to happen to us. And so their central bankers, they tried to print. They tried and tried and tried, and they couldn't get their economy growing. They call it the lost decade. It's going to be the same thing for our Fed. It's going to be like pushing on a string. So Kevin Warsh, he's known as not being a uber dove. So he's going to print, okay, I'm going to print $1 trillion. I'm going to print $2 trillion. I'm going to print 3, but he's not going to print 5 all at once. Because he knows if he prints 5 all at once, he's going to create, 5% inflation. 5% inflation kills your currency. So he can't print at will. He can print on the margin. The other thing where they're trapped, they can't cut rates severely. Right now, for instance, they didn't cut yesterday, and they're like, oh, we can't cut. We have high oil prices, right? How in the heck are they going to? Inflation's not going away. So how in the world did they get the Fed funds rate down to 1%? Which is what they need to restart the economy. So you can see what I mean. Yeah, you're being kind. There's no way out here.
So we've covered the fact that the bond market, which is the big market and the big problem, is trapped. Can't raise, can't ease without problems on either side. You also talked about the S&P, and that you're concerned when the S&P begins to roll over. We saw from March 3rd to March 10th, about a week ago, 2 weeks ago, asset managers sold $36.2 billion per the Commitment of Traders report in S&P futures, marking a 10-plus year record in notional terms. You've talked about waiting for the S&P to finally roll over. Cracks are now beginning to show. Is this the crack, maybe, that, brings the recession into focus? And if this is the trigger that finally starts sending mining shares into a real bull market, is this a possibility? Do you think that this is the fuse that brings not only the wisdom of staying in S&P stocks, maybe brings that little into focus that's not so wise right now, and maybe shows the value that you're finding in mining shares and in a real bull market, maybe?
Yeah, I'm glad you asked this question. So as far as I'm concerned, I'm after the prize. So when I got into gold, silver, mining stocks, it's all for big alpha. So in my book, in the introduction to my book, I basically said, I'm after 5X. Well, that was in 2010. Turns out I was too conservative. It looks like now I'm after 7X. So I really don't care about the near term. I really don't care about 2026. I just want to accumulate as many shares as I can get my hands on before they get pricey. And they're cheap right now. So I was buying stocks today. So I'm like, oh, this is great. The longer it takes, the more shares I can stack. So I'm just trying to stack as many shares as I can, waiting for the prize. The prize is not 2026. This could be the end of, this could be the recession coming on right here. Iran could be the trigger, or it could happen prior to the midterms, or it could happen after the midterms. But it doesn't matter. We're not in this. We're not trying to make money in mining stocks in 2026. We're trying to get to the top of the mountain. We're climbing the mountain. We're, and we're still at the bottom. We're still, we're not even halfway up. We're not even halfway up yet. And so we still got a long way to climb, right? You have to keep your eyeballs up there on the top of the mountain, because that's what we're after. So for me, the top of the mountain is $7,000 gold. Now, I'm probably too low. That's my target, 7,000. Now, if you use 1% of 7,000 is $70 silver. And I think that's no chance in heck you're going to only get 1%. Use 2%, you're at 140, which is a more legitimate number. Use 3%, you're at 210. So I think silver will be somewhere 175, 180, somewhere in there. Now, we probably will rip to 250, 280 at a certain point, but it'll come back down. So we're looking, for me, the whole thing, what I'm waiting for is $7,000 gold. We're not going to have $7,000 gold in 2026, right? So as far as I'm concerned, 2026 is noise. That's all it is. It's a period where we can accumulate. It's not a period where we take profits. It's going to be too early. Now, if Michael Oliver was right and we went to $200 silver in June and we stayed there for 6 months, then yeah, we would take some profits. That's a possibility, because you go to $200 silver and you stay there for 6 months, you're going to have 5-baggers all over the place. But I'm not expecting that outcome. So as far as I'm concerned, 2026 is a period of accumulation. It's a period of don't get excited, just follow the noise, follow the trend, follow the macro, see where we're going, pay attention to what's happening, but accumulate stocks.
Bank of America's lead metals analyst says silver could get as high as, I think, 309 by the end of the year, based upon a lot of things he's calling for 2026, which is interesting. I talked to, I've been doing this for a long time, Don. I've been doing this for 36 years, and I think investors freeze, some of them anyway, when it comes to mining shares. They'll buy physical gold, they'll buy physical silver. Many of them won't buy mining shares for whatever reason. Maybe it's a steeper learning curve, or it's greater volatility, leverage, which cuts both ways, upwards and downwards. So for the investor who's watching this, many of whom have done business with Miles Franklin before, but maybe still hesitates on miners, are they missing, in your mind, I think I know the answer to this, the most asymmetric, meaning low downside, high upside, part of this entire move?
Yeah, the thing that's rough is that, and it's happened right now, I mean, on this last couple days, is that people just don't have the stomach for paper losses of that size. We have the HUI down 28% from the top. That's a pretty big drop. A lot of people can't, not very many people actually bought the top here. But a lot of people, they're experiencing 10, 15, maybe 20% losses on some of the recent purchases. And, the average consumer, they can't handle that. So they have like a stop loss, and they end up losing money because they can't handle the volatility. You really should stay out of mining stocks. Just do physical gold and silver, stack it. I mean, I think you should do 10%, 5 to 20%, but I think 10% is a good number. Why hold money in cash when cash is getting inflated away? Cash is, when you can do physical. Think in terms of physical as cash. It's like your savings account. Like, a lot of people have a lot of money in a checking account, 50,000, 100,000, 200,000 in their checking account or the savings account. I have nothing in gold and silver. Take 10% of that and put it in physical, stack physical. That makes sense for everybody, right? You're not really investing. You're just collecting another asset that basically should hold more money than fiat. It's a very simple idea. We're seeing a lot of big banks on Wall Street basically say that, do 10%, 20% of your assets into physical silver or gold. Just as kind of a savings plan, because we can't really trust what's going to happen. It's getting more risky to hold stocks and bonds. Let's put it that way. Now, as far as people that have a little bit more risk appetite, that really want to go out there and go after these baggers, if you will. I mean, when you have Newmont Mining, which is the largest mining stock, gold miner, when I have it printing as a 4-bagger at $7,000 gold, but you got to get to $7,000 gold and stay there. You go to $7,000, Newmont won't be a 4-bagger overnight. It's going to take a few quarters for them to have the financials. And then the stock will start ripping higher as people start to believe that 7,000 is the new normal. But if you look at the free cash flow levels, and you look at their current multiple, these stocks have uber leverage. It's unbelievable how much leverage they have if we're right about the price direction of gold and silver. Now, we're at $4,600 gold today. If we get above $5,000 gold at some point this year and just stay there for 6 months, Newmont is going to be probably the best performer on the S&P 500. So this is a bet on gold. It's a bet on silver when you buy these mining stocks. But the easier way to do it, instead of just buying Newmont, is you can buy GDX, which is an ETF that basically is going to emulate Newmont. Or you can do some of these others. There's probably 8 pretty good gold silver miner ETFs. There's 8 gold and then there's 4 silver. So you can just focus on the ETFs and get uber leverage to these mining stocks. Now, you're only going to get, so the silver miners are going to have a little bit more leverage. So if you do the silver miner ETFs, you probably, you have leverage of, 4x, 5x, maybe a little better than that. But then if you really want to go for the leverage, then you can go individual stocks in the junior area. But read my book. My book explains all this. But you gotta be, if you're going to go into the ETFs, not as much volatility. If you go into the individual mining stocks, you got to be prepared for the volatility. This thing, the last 2 days is a great example, right? We had stocks down 5% yesterday, down 7% today, back to back. What is that? Compounded, pretty brutal. 15% maybe, something like that. Over 10% loss over 2 days.
So, that the leverage has always been something that cuts both ways. I understand that. And that's one of the reasons I have told people when talking about mining shares, focus on either the royalty companies or the big companies, and like Newmont. But I guess inside the mining space, I guess a question that I would ask is, what does separate the companies that merely participate in gold's rally from the ones that can truly deliver outsized returns? And is it wise for people to have any exposure to said stocks that have that ability to deliver outsized returns when, as you mentioned, that leverage is there and goes both ways, not just to the up, but to the down? And, I ask you this because I think, everyone loves the simple narrative. Like, for example, silver miners will outperform gold miners, juniors will outperform majors, etc. Maybe they do, but is this too simplistic? Is there a pattern or a formula that you have that lets people, recommends people to, or to recommend to people that have, allocation to the majors, maybe some of the royalty stocks, but how about the juniors or the exploratory stocks that would offer those outsized returns?
Yeah, so I've written a book that explains this perfectly. So I use a pyramid approach. So the pyramid is, at the base, you have bigger allocations on the base, and you're allocating to much lower risk. So the base is physical. That's where you start with the base. And then you have ETFs, mutual funds. That's your base. So you're focusing on lower risk on your base. Then the next level up is your majors, and you have less allocation there. Then the next level up above that is your mid tiers, and you have less allocation. Now that is where you want to overweight. So I'm overweight that big chunk, and then from there you go above that, which is your developers and your explorers, and you want to basically have low allocations. That's why the pyramid's getting thinner at the top. So I allocate more to the low risk and then less to the higher risk. And I've always told people, I basically take the emotion out of it. I give low allocations. So I actually own 106. I'm up to 167 individual stocks. I'm buying another one tonight. I'm going to 168. And if I have 168 stocks, you can imagine, I have a lot of stocks that don't have high allocations. So I really don't care. I take the emotion out of it. I don't really care if a stock goes bankrupt. I just replace it. I go buy another one. But the reason why is because I don't have high allocations in these stocks. And so that's why I said right now my target, according to my portfolio, if gold goes to 7,000, I have a 7-bagger, and that's fantastic. People tell me that they followed my system, and they told me that I have targets in my website. My website will tell you what the target is for a company. A guy has followed my strategy, and he has 60 stocks. I don't recommend 167 stocks. I think 50 to 80 is fine. If you're going to be a trader, you can go up 20 to 30, but most people are not good traders. So I think 50 to 80 is a better number if you're going for big alpha. But he told me he has 60 stocks. If he hits 75% of my targets, he will have a 9-bagger. Now he's more aggressive than me. So I'm 7-bagger because I have a lot of money in ETFs and mutual funds. I have, I think, 6 ETFs and 3 mutual funds. And then physical. So I have a lot of money down on my base where you can be a little bit more aggressive, but that's the kind of alpha that's out there for these stocks. I'll give you an example of what I mean by high alpha is that you can obtain it, which it kind of blows my mind how asymmetrical these bets are. I'll give you one example, Andy and Silver. So Andy and Silver, they have a very low they bought a mine that was on care and maintenance in 2022. So it was mining 1,600 ton per day mill, mining 5 million ounces of silver equivalent a year. It went on care and maintenance in 22 and silver prices were sub 30, sub 25. And then they bought it and they've been drilling it ever since. Again, it was mining in 2022 at 1,600 tons per day. And they found enough exploration potential on this property. They've identified 150 drill pads. So it's already 100 million ounces and they have 150 drill pads. This thing's going to get bigger. And the way that I value this company, it's very simple. So I basically use in my book, I talk about how I analyze a development company. And I want them to check all the boxes. And this one does. You want to make sure they check all the boxes. So the only risk is the price of silver. The only significant risk is the price of silver. So as long as silver stays above, say, $45, maybe $40, this company is, chances are it's going to go up a lot higher from its current valuation. I think its current valuation is a little under $400 million. But for every 1 million ounces, they're going to restart this thing about 5 million ounces a year. So the way that I value it is so they're going to mine 5 million ounces. For every 1 million ounces, if your break-even cost is $50 an ounce, and silver's at 100, you have $50 margins. So 1 million ounces times $50 is 50 million. 50 million free cash flow, right? And if silver goes to 100, it's 100 million in free cash flow. But let's just use $100 silver. If you believe we're going to $100 silver, and they're going to go into production in the first quarter of 28. And so if they get into production and silver's at $100 and they have $50 margins, that's 50 times 50. That's $250 million in free cash flow. If you put a 10 multiple on it, it's $2.5 billion valuation. Their current valuation's under 500 million. There's 4x there. All we need is $100 silver and we got 4x return. Now, if silver goes to 150, it's 8x return. Those are the kind of leverage plays that exist. That's only one. There's many of them.
No, that's why people should check out your work. I wonder sometimes why people fail to see things right in front of them, the warnings from the bond market, the institutionals dumping largest amount of S&P futures ever, the scale of the monetary reset, all of the things that are concerning to me that I talk about every day, and why they're all ignoring the absurdly cheap mining shares while most investors say crowded in the conventional equities. And I guess I'll close with this, Don. I appreciate your time today. You made my job easy today. Thank you for that. Are people still thinking far too small about what's coming? Not just for gold and silver, but for mining shares and really for the entire system itself. Is this the big problem, that people just don't see what's coming, don't see the opportunities in front of them, and are going to miss out on not just outsized profits, but I think if you aren't thinking like a contrarian, as our mutual friend Rick Rule says, you're setting yourself up to potentially be a victim. What's your thought on that?
Yeah, so I'm like you, been analyzing this stuff for 30 years, waiting for this outcome, expecting this outcome. I mean, this isn't something that's a surprise. This is an expectation. Now, am I wrong? I don't think so. No. Yesterday, I heard Bob Moriarty say that only 1% see what's coming. 99%, 99% of people are clueless of what's coming. Now, and I haven't heard too many people, I've been saying this. I said that this is the last year of American greatness. And he said in his interview, this is the end of the American empire. And me and him are completely simpatico in that regard. Now, we're not the only people that are saying this, that this is an epic shift here. Absolutely epic. Jeremy Grantham, the king of the bubble, he said this is the worst one. Jim Rogers, he's been around since the 60s, fantastic investor. He said, what's coming? I know this is the worst that I'm going to experience in my lifetime. Right? Ray Dalio, he's been saying this is a global monetary shift, people. Right? So we're hearing some really big voices out there. Warren Buffett's all in cash. We're hearing some really, really big voices. And these are the people I pay attention to because these guys are older than me. They've been around the block more than me. And these guys are, really bright dudes, right? And they're all worried. And like I said, this is not a surprise. We've been talking about kicking the can since the early 2000s. A long time ago, right? Here we are, 25 years, and now we're at 39 trillion, adding $1 trillion every quarter. And we have a president who is basically, keeps poking the bear all over the place, right? Creating this, we didn't even talk about China and the US's geopolitical issues that are going on right now, right? I think this meeting between Trump and Xi is going to be canceled. I really do. But yeah, thanks for having me on, Andy. I think that the writing's on the wall. I think that the recession's coming, and I think when the recession starts, I've been saying this, it's not going to end, and it's going to be It's going to be shocking to the system. This is literally, the U.S. has been living beyond its means. If you really look at history and you look at how America's evolved since 1945, we've been living beyond our means on the backs of foreign money. And that's getting rug pulled. And so that's what's coming. And so the question is, what's going to be the fallout from that? I firmly believe that we're going to see revolutionary change. We're going to see banks close in large numbers. We're going to see colleges close in large numbers. We're going to see businesses close in large numbers. And they're not coming back. When these companies go out of business, they don't come back, right? We've seen that in our lifetime. We've seen a lot of chains close, they don't come back, right? That's going to be what happens. Banks close, they don't come back. Colleges close, they don't come back. That's what's around the corner here. And so that's the reason why I kind of own gold and silver, is because, okay, I see the train wreck that's up ahead. I got to get prepared for it. I can't, like you said, what Rick Rule said, if you're not prepared for it, you're going to be the victim of it. So I'm like, okay, I can either be the victim of it or I can get ahead of it. So I'm getting ahead of it. And I think I think it's in some respects kind of our duty to kind of get ahead of it, because we're going to have to rebuild this country. We're going to have to rebuild it. And so who's going to rebuild it? It's going to be the people that are kind of expecting the fall down, right? The people that are kind of preparing for the outcome. And so that's kind of where I've been. I've been kind of preparing for the rebuilding for like 30 years. I've kind of known we're going to have to rebuild this thing. I would like to, one final comment, I would like to just retire and go to Maui and do nothing. That would be my preference. But my gut says, Don, you can't do that. You got to help. It's coming. It's a mess. You got to stick around and help. And so that's what people need to recognize. You need to recognize that, okay, we are the generation. We are literally the generation that creates the next America. But it's not going to be called America. But we are the ones that are going to create it. And we are literally on the precipice of that whole breakdown. And once it breaks down, at that point, we're like, okay, it's time to start over. We are going into a start over event. And that's what people need to recognize. And you need to get ahead of it. you need to start stacking physical silver and gold. It's important. And the people that have the physical silver and gold are going to be in a much better position, because when the reset comes, and I think, Andy, you've talked about this reset. The reset comes, the dollar is going to be devalued anywhere from 30 to 40%. So you're going to wake up one morning and your bank account's going to be worth 30 and 40% less, and your stocks and bonds are going to be worth 30 and 40% less. But guess what? Your gold isn't. We've seen this happen over and over again. Your gold and silver is still the same value. That's the reason why you stack gold and silver, for the reset. But thanks for having me on, Andy. I knew I was going to enjoy it. It's been great, and hope to see you soon.
Yeah, it's too bad not enough people see things clearly these days, and unfortunately, if you don't roll with these changes and even are able to see them, well, you get rolled by them. And I feel the same way. I wonder sometimes why I do what I do and put myself out there as much as I do, and I don't need to do it. But at the end of the day, when we all have to meet our maker someday, what did you do to make the world a little bit of a better place? Sometimes people confuse that with talking my book, which has never been my issue whatsoever. I think running a business and trying to do the right thing, trying to impart wisdom or the way that you see things, maybe a contrarian view, being that we are such a minority in this environment. Those that listen may come out ahead. Don, I appreciate your candor. What is the best way for people to follow what you're doing, to follow your mining shares that you're choosing or owning or recommending, and just your macro take on things? What's the best way for people to keep up with your work?
So if you already own gold and silver mining stock, then check out my website. It's really a tool for people that kind of already own them. It's not a place where I'm just come and get stock picks. That's not what we're about. And then if you don't own any, but wow, that sounds great, I want to own some of those, read my book first. So you can get my book on Amazon. Just go Don Durrett Gold Book. You'll find it. And but thanks for having me on, Andy.
You got it, Don. Stay well, buddy. I look forward to seeing you in person again back in Vancouver, if not before.
Right.
This is Little by Little with Andy Schectman.